In traditional markets, let's say if you want to trade in the CME, this collateral is not going to come in the form of dollars. It's going to come in the form of treasuries, because you're going to get that yield and that positive carry that can make a massive difference depending on the trade strategy that you have. In crypto, it's actually a little different and less efficient, which is kind of surprising that we come this far and we still have this level of inefficiency in derivatives collateral pledging in crypto. Just for a little bit of history, and I'm sure many know this, but in the earlier days, it even used to be a little worse. I think a lot of crypto derivatives contracts, they used to be collateralized in Bitcoin, right? Then we went from Bitcoin to stablecoins, which is an improvement because you kind of get like, you get just like better risk management there if you're quoted in US dollars. And now, perhaps the next step here would be to start accepting money market funds or tokenized treasuries or some sort of yield-bearing collateral for these, at least initially, crypto derivatives contracts, right? This is a big market. We're just talking on the back. If you add the open interest for just probably the third largest assets, Bitcoin, Ethereum, Solana, and if you look into open interest for futures and options, you're probably talking about $100 billion or more. So there's a fair amount of stablecoins that is actually used to collateralize these perpetual contracts, futures markets, and things like that. And I feel like it makes a lot of sense for us to move from non-yield bearing to yield bearing. Of course, there's some regulatory unlock and clarity that needs to happen, but I think that's kind of how I see it.